Disclaimer. February 14th, 2026, and the global financial system just crossed a line it can't uncross. Trump's latest tariff announcement didn't simply irritate Beijing, it set off something far more serious for the future of the US dollar. Within 72 hours, 3 BRICS nations made decisions that would have seemed impossible 5 years ago. They moved quietly and decisively. Meanwhile, Wall Street is acting like nothing unusual is happening. Here's what unfolded beneath the diplomatic language and polished press releases that almost no one is connecting. On February 10th, Brazil's central bank revealed a new $30 billion bilateral currency swap agreement with China. That very same day, India discreetly broadened its rupee-based trade settlement framework to include energy imports from Russia. Just one day later, Saudi Arabia confirmed it will begin accepting yuan for a share of its oil exports to China starting next month. These developments aren't random. They show coordination. And the spark was Trump's declaration of 60% tariffs on Chinese goods. But this situation is different from every previous trade conflict. This time, there's already an alternative financial structure standing by. Over the past 3 years, BRICS countries were constructing the infrastructure necessary to operate outside the dollar system. They developed cross-border payment channels. They increased gold reserves. They structured energy contracts in domestic currencies. The moment trade access was threatened, they were prepared. And that preparedness poses a serious challenge to dollar dominance. Let's break down the mechanism that weakens America's financial leverage in ways most people overlook. When you force countries to choose between access to U.S. markets and their own financial sovereignty, you must be confident they'll choose you. Trump's strategy assumes China, India, Brazil, and Gulf nations rely more heavily on American consumers than on financial independence. That calculation assumed tariff pressure would outweigh the long-term incentive to build a parallel system. But what if that parallel system is already operational? What if they were simply waiting for the right political justification to activate it? That appears to be what's happening now. And the consequences extend far beyond trade statistics or diplomatic tension. The dollar's global role is no longer anchored by gold or purely by economic fundamentals. It's sustained by habit and by the absence of strong alternatives. For decades, countries used dollars in trade because everyone else did. It was the default setting, the easiest route. But defaults shift. And once confidence begins to change, momentum builds faster than most expect. Think of it like a bank run. As long as depositors believe the bank is stable, it remains stable. But once doubt spreads, collapse can occur within days, even if nothing fundamental has changed. That's the real risk here. The tariffs didn't just impose economic penalties. They reminded the world why it has been developing an exit plan. Every time the dollar is used as a geopolitical tool, through sanctions, asset freezes, or trade restrictions, holding dollars becomes more politically risky. And risk drives the search for alternatives. That search is now becoming action, at a pace that should concern U.S. Treasury officials. Here's the misunderstanding in Washington. De-dollarization isn't about instantly replacing the dollar. It's about building flexibility. It's about ensuring that when economic pressure is applied, you have another path available. Saudi Arabia isn't abandoning the dollar entirely. It's ensuring it isn't dependent on it exclusively. India isn't aiming to dismantle dollar dominance. It's ensuring it can function without it, if necessary. This is financial hedging, and every tariff or sanction increases the value of that hedge. So what comes next? Does this momentum continue, or does someone step in before deeper fractures form? That depends on whether Trump recognizes what has been set in motion. At the moment, signs suggest he may not. If you're beginning to see how this shifts global trade, currency flows, and power dynamics, share your view. Does escalation continue, or does de-escalation follow? Let's see who reads the trajectory correctly. Now, let's examine the infrastructure that makes this possible, because this is no longer theoretical. In October 2023, BRICS nations introduced a payment mechanism through the new development bank that significantly altered the landscape. It received little attention in Western financial media, but it laid the groundwork for what we're seeing today. The system allows Brazil, Russia, India, China, and South Africa to settle trade directly in their own currencies. No dollar conversion required, no reliance on SWIFT, no automatic exposure to U.S. oversight or sanctions risk. Initially, Western analysts dismissed it as symbolic. They argued it would never reach meaningful scale. That assessment now appears deeply flawed. In 2024, China and Brazil conducted $43 billion in bilateral trade using yuan and rials directly. That's not experimental. That's significant volume, larger than the GDP of some smaller nations, completed without touching the dollar. After being cut off from SWIFT due to sanctions, Russia and India expanded direct settlement systems as well. By 2025, India purchased 70% of its Russian oil using rupees and rubles entirely outside the dollar system. Now add Saudi Arabia to that shift. If just 20% of its oil sales to China transition into yuan, that represents roughly $60 billion annually bypassing dollar settlement. These figures may sound abstract, but their implications for dollar demand are profound. Historically, global trade created automatic demand for dollars. That demand kept Treasury yields suppressed. Lower yields allowed the U.S. government to borrow cheaply, funding everything from defense to infrastructure at favorable rates. But when trade happens directly in local currencies, countries no longer need to maintain vast dollar reserves. They can reduce Treasury holdings, they can limit dollar exposure, and that creates a reinforcing cycle. Less dollar demand leads to weaker Treasury demand. Weaker demand pushes yields higher. Higher yields increase debt servicing costs on America's $35 trillion debt. Higher costs require additional borrowing. Additional borrowing often requires monetary expansion. Expansion increases inflationary pressure. Inflation reduces the dollar's attractiveness. And the cycle feeds itself. This scenario has been quietly modeled within Federal Reserve circles for years. What makes this moment uniquely risky is speed. A process once expected to unfold over decades is compressing into years, possibly months. Historically, reserve currency transitions were gradual. When Britain's pound sterling ceded dominance after World War II, it took decades. The current shift could move much faster because the alternative infrastructure already exists. Trump's strategy appears rooted in assumptions that worked in prior decades, and when America's financial dominance was unquestioned. But in 2026, with BRICS representing over a third of global GDP, the leverage equation looks different. China is now the primary trading partner for more than 120 countries. If Beijing offers settlement in yuan with reduced political exposure, many countries will consider it. Previously, they lacked the operational tools to execute that shift smoothly. Now those tools are in place. If this trajectory continues, we may see a wave of quiet central bank announcements about reserve diversification. It won't happen dramatically. It will unfold gradually, in policy notes and quarterly disclosures. But cumulative change can reach tipping points. Reserve currency status isn't binary. The dollar doesn't need to disappear to lose influence. If global trade usage falls materially, even from dominant levels, the financial consequences for U.S. borrowing costs and influence would be substantial. One underappreciated benefit of reserve currency status is inflation exportation. When the Federal Reserve expands money supply, global demand absorbs part of the impact. If dollar demand shrinks, inflation pressure becomes more domestic. That dynamic would reshape economic realities for American households. Trump's tariff policy is accelerating the timeline by providing political justification for countries to implement systems they've already built. They can frame diversification as defensive rather than confrontational. Sectors most exposed would include international banks, multinational corporations, treasury bondholders, and industries dependent on stable currency flows. In a true dollar crisis, traditional safe havens may not function traditionally. Gold accumulation by central banks suggests strategic preparation for this possibility. China and India have both expanded gold reserves significantly in recent years, not randomly, but deliberately. What we may be witnessing is the opening phase of a historic monetary transition. The central question isn't whether change is happening. It's whether it unfolds gradually and managed, or rapidly and disruptively. Trump's posture suggests escalation rather than accommodation. Global monetary systems don't function like private business negotiations. You cannot simply walk away without consequences. Countries building alternatives are not attempting immediate destruction of the dollar. They're building flexibility, and flexibility shifts negotiation power. For decades, there was no viable substitute for dollar settlement. That monopoly created leverage. Monopolies weaken when alternatives become credible. Over the next 12 to 18 months, additional bilateral trade agreements excluding dollar settlement are likely. Commodity pricing may increasingly diversify. American corporations may face currency exposure or restructuring costs. The Federal Reserve could face a policy dilemma between supporting growth and defending the dollar. Political pressure will intensify. This is not investment advice. It is an observation that long-standing assumptions about American financial dominance are being tested. The direction of change is visible. Those who understand the shift early can adapt. Those who assume the old system is permanent may be caught off guard. This is not about partisanship. It's about recognizing structural change in the global financial order. The infrastructure has evolved. Alternatives now exist, and that alters the game entirely. If this analysis helped you understand what's really happening behind the headlines and official statements, make sure you're subscribed to this channel, Economic Records, because this story is just beginning. The next 6 months are going to be critical for anyone with money in global markets. The decisions made next will determine whether this transition stabilizes or accelerates. Either way, understanding the trajectory is essential. Thanks for watching. I'll see you in the next one.